Welcome back to our intermediate financial accounting class. In this section, we're going to continue on with our discussion of the accounting cycle by doing some more adjusting entries. So far, we've done lots of pieces of the accounting cycle. We've talked about what the cycle is, why it's important. We've talked about identifying transactions, doing basic entries, doing the posting, talked about using the account equation to come up with all the different pieces that go into a T account or a ledger account. And then we started talking about adjusting and correcting entries. We've talked about the steps to them and done the first couple examples of an adjusting entry. One that had to be made, one that didn't have to be made. So in this segment, we get to continue on with that discussion, jumping into more journal entries. So let's go ahead and get started with this next example here. In this example, we received $2,000 rent on November 1st. It's supposed to be 4 months worth of rent, and we received all of it up front. So the question is, always the first question, do we need an adjusting entry? Well, let's see. We would have gotten the cash on November 1st. When we get to December 31st, I haven't earned all of it. I've only earned half of it, which means, yeah, I'm going to need some kind of an adjusting entry to record the fact that I need half of this revenue. So, next question is what accounts are going to be affected, and that depends on what entry I made on November 1st. So let's take a look at the two options. Did you figure out the two journal entries that could have been made? I hope so. They look like this. I could have put it all into unearned revenue up front. So I would have recorded the cash for $2,000 and unearned rent revenue for $2,000. It's a liability, so it's got a credit balance. Received rent on office. 4 months. That's one option. Option number 2, I could have still recorded the cash, of course, because that happens one way or another. I could have gone ahead and recorded all of it as rent revenue up front. And it would have the same description. Received rent on office. 4 months. What adjusting entry would you make for the first entry, recording it as an unearned revenue? What adjusting entry would you make for the second entry, recording it all as rent revenue as opposed to unearned revenue? You ready to see how you did? So on 12/31, in this case, I would realize, hey, I've earned some of that rent now. I have allowed them to stay in my building for 2 of the 4 months, and I get to record that revenue. So I'm going to take it out of unearned revenue. That's a debit. And record it as rent revenue. How much? Well, adjusting entry for rent revenue. Fix that in. There we go. $2,000, and you can just divide it by 2, or you could take the $2,000 divided by 4 months times the 2 months that have passed. Either way, we end up with $1,000. So that's one option. Option number 2, in this case, I showed all of it as rent revenue, but I haven't really earned all of it because I've only let them stay there for half the time I said they could stay there. So I need to pull back some of that rent revenue. So let's see. We're going to debit rent revenue and credit unearned rent revenue. Same basic calculation. Adjusting entry for rent revenue. And I'm just going to do the 2,000 divided by 2 this time. And there we go. Now, you can do this either way. Again, you're going to end up with the exact same balances, so it depends on how your company wants to record them. This technically is GAAP. You would record it as unearned revenue first and then record it as rent revenue as you earned it. But since you end up with the same numbers, it really doesn't matter. All right, let's take a look at the next one. In this case, monthly payroll is $25,000. It's paid on the 15th every month. So again, the first question is, do we need an adjusting entry? And the answer is yes. These people have worked for 2 weeks for us, from December 15th when they got their last paycheck to December 31st, the end of December. We owe them that 2 weeks. Even if we close down the shop, December 31st, never open it again, we would still have to pay them for the 2 weeks they'd already worked for us. So I need an adjusting entry, even though there's no cash involved. Second question, what accounts are involved? Well, in this case, there's no beginning entry, right? They've worked these 2 weeks, but I haven't recorded anything at all for it. So I don't have a beginning entry to worry about. That leaves me only one option. So what account should I use? Well, I owe them this money, so we need to use a wages or a salaries payable, a liability to show that I owe them these wages. And with the liability, I'm going to record an expense because they've worked for me and the owners are out that money, so I'm going to show that it comes out of owner's equity and not out of a liability here. So when we do this entry then, again, the next question, I don't use cash because I haven't sent a check to these people, but I need to make sure I've got both a temporary or income statement account and a balance sheet account. Wages payable, balance sheet, it's a liability. Wages expense, that's an expense, cleverly named, right? So that's an income statement account. So I'm good. So on 12/31, I need to record wages expense. It's an expense, so it's got a debit balance. And a wages payable. Adjusting entry for wages. And in this case, it's $25,000. 25. And they've worked half a month for me, so I owe them $12,500. Let's take just a second here and take a look at what the journal entry would look like next year. What will we do when when January 15th rolls around and we make this paycheck? What will we record? Well, on January 15th, the cash is going out. I owe them $25,000. Then what would I do? Well, I would get rid of that payable. I'm now paying off this stuff. So I'm going to get rid of that. So I credited it here. To get rid of it, I will do the opposite. And then they worked for 2 more weeks, so I earned the rest of that money. So now I record that as an expense for this year to pay monthly payroll. So now, I don't have to record that expense again, but I'm going to get rid of the payable because I'm now paying it off. Now, I want to do one other thing. If you remember our discussion of the accounting cycle itself, way back in the very first segment to this discussion of the accounting cycle, we talked about reversing entries. And I said most people don't use them, but sometimes you do if you've got a computer that processes on a specific day, you've got a bookkeeper who doesn't know what he or she is doing, you might use an adjusting entry, or excuse me, a reversing entry. So a reversing entry works like this. On 12/31, the accountant who knows what he or she is doing would come in and they would make this entry. Whoops, there we go. That's much better. Okay? Make sure we get the numbers involved or it's a very bad journal entry. Then, on January 1st, before the accountant goes home and leaves things done, they would reverse it. So, wages payable, $12,500, and wages expense, $12,500. Reversing entry for wages. Now, December 15th rolls around, and either the bookkeeper, who's clueless, or the computer system doing batch processing does their normal every month journal entry. Wages expense, monthly payroll. Now, if we look at the T accounts here, we can see that both of these ways work out. It's just a different way of doing it. Matter of fact, let's go ahead and do the TACAPs again, just so that we can see them. So up here, there's your wages expense, and here we'd end up with 12,500, and wages payable. You would start with this as a beginning balance, because we did that last period, and it's a liability, so it keeps its balance. And then 12,500, wages payable goes to 0, and end up with wages expense, at least at the end of January, of 12,500. Now down here, wages expense and wages payable. So in this case, let's see. We have wages payable beginning balance still from up here, 12,500. And then here in my reversing entry, I get rid of that. So that goes to 0. Wages expense, I credit 12,500 right here. And then I record a wages expense total of 25,000. Now if I net those out, again, this goes to 0. If I net these out, I end up with 12,500. You'll notice 0, 0, 12,5, 12,5. So that's what we're doing with a reversing entry. Again, you don't see it very often. It's only used when companies use batch processing, or they got somebody who doesn't really know what he or she is doing. But just so you're aware, that's kind of what we're looking at with these entries. All right, let's take a look at one more. So in this case, work on a large order was completed on December 29th of year 1. The client picks up the order on January 10th of year 2 and will pay at that time the full $35,000 owed. Cost of the job, $25,000. Take a minute. Make the adjusting entry. In this case, what does the journal entry look like? Well, again, it's a very simple entry. If you remember our principles for revenue recognition, I identify a contract, there's an order, I figure out the parts of my contract, that was the work that I needed to do. Step 3, I figure out the price, there's the price, and I allocate that to my deliverable. In this case, the work that I promised to do. As soon as the work is done, I get to record that revenue. So by December 31st, this is all done. I would record the whole thing as a normal entry on December 29th. In December, I'd record their payment and get rid of the accounts receivable, and I'd be finished. So there's no adjusting entry because I would do it as a normal entry back when I got the work done. Let's go ahead and stop here. We've done a couple of really fun journal entries, talked about some cool things. We'll come back in the next segment and finish up our examples of adjusting entries. See you then.